Well, so we are starting financial accounting. So this is our first topic in our financial accounting, in which we define what type of statements financial accountants are supposed to prepare at the end of the accounting period. So financial statements is the topic under our main course title, financial accounting. So let's start with the uh, topic like financial statements. What are financial statements? How we can define that these are financial statements? So financial statements are the business documents that companies use to report the result of their activities to various user groups. So the system of accounting produce the following statements. So the accounting system is used to produce at the end of accounting period few statements which are useful for the specific users. So what are these statements? That's our important question, and right now what we are trying to answer. So after this accounting process, like when you do some transactions, what you have to do, we have to record it, and then at the end of the period, what we do, we transfer those transactions from journal to ledger, and from ledger to trial balance. From trial balance, we prepare an adjusted trial balance, and finally we start preparing the financial statements. So this is a whole process, and at the end of the process, what we do, we want to produce these four financial statements. The objective is those who are interested to know about the health of the organization or a firm, these four statements are useful to understand their financial position or financial health of the business. So the first statement is income statement, and that reflects the result of the business over the last accounting period. And this, as the name is reflecting, it's an income statement focusing only on the income. And how do we calculate income? Means that we look towards the revenues and expenses, and the net position is our income. So in this statement, we focus only on revenue and expenses. Then comes the statement of retained earning. This is the statement which reflects that how much the business is earning and keep what portion of their income into the business for the growth of the business. So whatever the income we generate, we take it to the statement of retained earning, and from retained earning, if we distribute some of the profit or a certain portion of the profit towards the shareholders, that's what we call it as a dividend. So we pay dividend from the statement of retained earning. It means that dividends are reflected in the statement of retained earning. Then comes balance sheet. Balance sheet tells us about the financial position, how many assets they have, how many liabilities they have, as well as the shareholders' equity in the business. And mostly shareholders' equity is reflected through common stocks as well as through statement of retained earning. How much is we take the figures of the balance of retained earning from the statement of retained earning. Then comes the statement of cash flow. Cash flow, as the name reflects, that how much the cash is flowing. Flowing means coming in to the business and coming out of the business. Income statement is on accrual basis. We earn something but not yet received is going to be reported as an income. The expenses incurred but not yet paid is going to be reported as an expense in income statement. But cash flow statement is reflecting that how much really we paid, how much really we received. And this reflects the position that how healthy the organization is if the flow is regular. So if I normally I explain this way in a way which is more understandable, like the blood is flowing through our body, and there's a specific rate at which they have to flow. If it is over that rate, then we call it as a high blood pressure, or if it is flowing less than that rate, then we say that it is a low blood pressure. So same is the case with the businesses. Like if the cash flow is more than what we required, then there is some possibility of a hemorrhage or something like this, means that misutilization of resources. And if the flow less than, then the business is struggling in order to meet their obligations. So that's important from this perspective, to look at the health, in real sense the health, because blood pressure tells us the health of a patient, and same is the case with the cash flow statement, reflects us the health of the organization. Now, how the accounting information flows. So people, managers, those who are responsible for making decisions for the organization, they make decisions what they have to buy, where, what they have to sell, at what price, at what cost they have to buy, how many people they have to hire as a worker. So these are all the decision making process taking place at the level of managers or supervisors or board of directors. So these are all the people who are involved in making decisions. So when they make decision, the financial impact of that decision is going to be reported as a business transaction. And business transaction, whenever there is a business transaction, we have to record in our accounting records. So by this way, that is going to happen. And this business transaction, companies in a way to show that what is the result of this all, what we did during the last accounting period, is reported as a financial statement. So companies reports results in the shape of income statement, in the shape of statement of retained earning, or a balance sheet, or a cash flow statement. So these are the results, and this is, we can say it is a summarized way to tell the people that what we did during the last accounting period. Now, who are interested to know about these information or these statements? So there are many people, or a group of people are interested to know about those statements. Some are mentioned here, like individuals. Like individuals means it can be a student who is doing some research on that particular business. It can be a faculty member who are doing research on that. So these are the different individuals, those who are interested and to know about any company, or someone is doing a research on something, or someone is writing some specific report on any company. So that those are the individuals that they are interested to get these four different statements. The other one, which is the most important one, is the investors, the one who is a potential investor for a firm. So the way that he can get information about that business in which he has a plan to invest is these financial statements. The second important one is the creditor, like the one who is lending money to the organization in shape of bank loans or in shape of bonds. So those are interested to know about the financial position, financial situation, income, how much they are earning, how much they have a retained earning, how much the cash flows during the period. So by this way, they are also interested to know. So these are very important group of people, those who are interested to know, and they are also interested in a way that these statements should be correct and accurate. The third is from a taxing authorities. So definitely every business has to pay a tax as a corporation. So when they have to pay a tax as a corporation, so what is the way that they can calculate, or they know that how much income, how much assets, or all these informations that is required to calculate about their tax they can get through these statements. The other regulatory bodies, like a stock markets or a Securities and Exchange Commission, so these are the organizations, they are interested to know about their firm's position and their incomes. So they are also interested to know these statements. Non-profit organizations are also interested for doing research, for doing some analysis. Also, if they are interested to invest as a non-profit organization, but they are doing some investment like pension funds, and these are the things that they are interested to know about the firms. So these are the major users of these financial accounting information. Now, before going into detail about our course, which is the financial accounting course, it is important to understand the difference between financial accounting and managerial accounting. Why it is important? Because in a financial accounting, what we have to do, we have to follow certain standards set by the International Financial Accounting Standard Board, or standards set by the our internal within the country regulatory body for accounting. Why it is important that we have to follow the standard? Because the users of these reports, what we generate in our financial accounting, are the external people, those who are not directly involved or inside the business, so they don't have a direct information from the business. So those people, or those parties or stakeholders, those who are not directly involved in the operations of the business or running of the business, so they want to know that how the businesses are performed. So if they don't know exactly more detail, and we want to give some figures, it should be standardized. Because the readers are very different, so they are from a different origin, so they have a different geographical location. So that's important, that whatever the information they are getting, it should be standardized, so that every reader of the information is taking the same meaning what the others are taking, and what the presenter is want to do. So that's why it is important. On the other hand, the managerial accounting is an accounting. The objective of that accounting is to provide more detailed information to the decision makers within the organization, internal use. So that is for internal use. And for that reason, if there is an internal user and they want some statements, and the managerial accountant provide the statement, so if he's not getting what this statement means, or what does, how they calculated and how, so they can call and they can have a discussion together to explain that why there is a difference, or how they can calculate it, or what is the meaning of it. Because it's an internal producer for internal users, so that's their communication is more easy and more frequent as compared to the external users. So for that reason, there is no such standard. So they are trying to provide the information as per the requirement of the managers, those who want information to make decisions. So let's see what we are saying. Provide information for external users, and we just discussed these external users like investors, creditors, government regulatory bodies, and the general public. On the other hand, the managerial accounting information for external users, and includes only, and they also are responsible for budget and forecasting about the businesses. Now, what type of businesses normally what we have to deal with when we are using or providing accounting process or accounting information? So there are three different major categories. Like there are other ways that we can do business as well, but these are the most commonly form of businesses. One is a proprietorship, in which there is only a single seller, only one single owner, and that person is responsible for all his or her business wholesale, means that everything he is responsible for that. So that's the way. uh, Proprietor is personally liable. Why? Because he is doing a business which he is altogether, in all respects, is responsible for. Whatever he is committed, or whatever he is agreeing upon, he is responsible to do that. If he borrowed money for the business, and he is responsible to pay from the business or from any other source, but he has to pay back. So this is the way that the liabilities are very unlimited for the proprietorship. The second form is a partnership, in which two or more people join hand together to do some business, and partners two or more, and partners are personally liable. It is not possible that all partners have a limited liability. Yes, there is a possibility that few partners can have a limited liability, but it is not possible that all partners have. And that type of partnership, we call it as a limited partnership, in which there are few partners who has a limited liability. Limited liability means that they are only responsible for the amount they invested in business. So their private property, their personal property, their personal assets are not responsible to pay back the liabilities of the partnership. So partners, at least one of the partner has an unlimited liability. All others can have a limited, but there is a possibility, and that's a very common, that all partners have a unlimited liability. So then the third form of a business is a corporation that you registered as a legal entity other than the owners of the business. So stockholders, usually many, in which there are many shareholders and stockholders. And stockholders are not personally liable for the liabilities because it's a separate entity. So that entity is doing whatever business he is doing. So his actions, for his actions, or for the organizations or a business actions, the owners in the shape of stockholders, they are not liable for all the activities. Yes, their liability is restricted to the amount they invested in their stocks. For example, like if you invested $100, your maximum loss can be of $100, right? That's a maximum loss. But in a partnership or in a proprietorship, if you invested 100 and the company suffered a $200 loss, so you are responsible for 200 loss. Not you can say, no, I invested only 100. No, you are responsible for all the loss. But in corporations, the beauty is this, that you are responsible only for the money you invested. So that's the way we call it as a limited liability, and corporations have a limited liability. Proprietorship, as I mentioned, single owner, common business from small retail stores and professional service providers. So these are, as there is only one person who is managing all the things, so it can not grow too much. And financially also, a single person resources are limited. So for that reason, we say that this is a limited small scale businesses. Excuse me. Proprietors personally liable for business debt, right? That's what I explained. Now, partnership, two or more partners as a co-owners, not a tax-paying entity. Income passes through partners, so it's not a separate entity which has to pay the tax independently. But the partners' income, they have to report it, those incomes, as their own income, as their personal income, and they have to pay the tax on it. Governed by an agreement, there is a contract between the partners. Mutual agency, each partner can act on behalf of the entity, and as I mentioned, there is an unlimited liability for all the partners. But in some cases, it is possible that few partners can have a limited liability. Involve risk, definitely there is a risk in the shape of limited liability partner lessen risk, but this risk is lessened only for a limited liability partners, not for all the partners. The partnership is mostly common among the professionals. Few doctors join together to run a clinic or a hospital. Few lawyers join together to run a law firm. Few accountants join together to run a accounting firm. So by this way, there is a possibility that professionals can run this partnership. Corporation, owned by stockholders, stock represents share of the ownership. Ability to raise large sum of capital and larger than proprietorship and partnership. Farmers under federal or formed under federal or a provincial law, legally distinct from its owners. So it's a legal separate entity. It is different than owners, and this way of doing business is capable of generating huge amount of money to do large businesses. So this is the problem with the corporation is double taxation. As we mentioned, that a proprietor is paying tax only as his own income. There is no tax on the business income. Partners are also paying tax on their income generated through the partnership, but a partnership itself is not paying a tax. But corporations, because of its separate entity, legal entity, they have to pay a tax. And that's why we are saying double taxation means that the corporation's income, overall income, when they calculate it, they have to pay a tax on it. So whatever is left after tax, they distribute it to the owners through dividend. And when the owner is getting a dividend, so they have to pay a tax on dividend as well. So it's a double taxation. shareholders tax under the distribution of income as a dividend. So stockholders elect board of directors and set policy. And so normally the stockholders are not involved in running the business, and they only participate in the election of the board of directors. And the board of directors are the policy making body, or governing body for the corporation. Under the board of directors, the corporation is run through professional managers, and professional managers are the agents. So they are not the owners. The only owners are separate and management is separate, and they are running through this. So there is a possibility of a principal agent problem as well in the corporations. So corporations have some advantages, but at the same time there are a few disadvantages, and I just explained you double taxation, and a principal agent problem is common in the corporations. So this is the first part, in which we just introduce what is financial accounting, and what statements we prepared in the financial accounting, and as well as what different forms of businesses what we can use. So thank you very much, and please continue to watch the second part and the third part to complete this topic.